Hello and good afternoon, everybody. It's 2 o'clock and it's time for our daily COPEC Financial Wellness Webcast. Looking forward to a great conversation today. We've got Rick Zwelling, who is a financial advisor, and he works a lot with budgeting and credit and things of that nature. Understanding credit and credit scores is going to be our topic of the day. We've got the disclosure up in front of you there, a little bit about COPEC and then affiliated companies and the board and things of that nature. So take a look at that briefly if you would. And then you can also see that at the bottom of the copeceducation.org website in case you want to review it a little bit. If you want to join us here, there you are. Great to have you. And today we're going to talk a little bit about, credit scores and credit reports. And if you can give us a little bit of an overview of not only you, but also what we're going to be talking about today.
Sure. Thanks, Jay. And it's a pleasure to be here. So again, my name is Rick Zwelling. I'm an accredited financial counselor. So all I do is teach. I teach both in one-on-one coaching as well as group classes. The objective is to help people, give them the skills and the confidence that they can make better financial decisions and reduce the amount of stress. I sell no product. I don't do investments. I don't do insurance. To tell Jay, my goal is to make people financially healthy, and Jay in Retirement Strategies helps make them wealthy. So today we're going to talk about credit scores, and kind of the impact it could have. First of all, the way I look at it is that credit scores represent our reputation to those who don't know us, and so they can impact both the availability of getting debt as well as the cost of debt. And so the higher the scores, the more options someone has in terms of financing, as well as the lower the interest rates. And then the opposite is true. The lower the scores, the fewer options, and the more expensive it can be. So I'm going to go and share my screen a bit and kind of go over a couple of things. First of all, statistics is that so many people are struggling building an emergency fund. People are getting physically ill over their finances, and not enough people are doing budgeting. All this impacts credit because, again, if someone's tight, then you're robbing Peter to pay Paul, who's not getting paid. And if people aren't getting paid, creditors aren't getting paid, it can drop credit scores and add stress to one's life. So, one question is, why even have credit scores? Why even have that? And so, what they found is that credit scores are a good predictive tool to measure the risk. And more and more organizations are utilizing credit scores. It used to be just for loans, say for cars or homes, but also say for life insurance premiums are sometimes based on one's credit score. Some employers are looking at credit reports and credit scores as well, in terms of determining whether to hire somebody or not. Certainly renting an apartment, even cell phone providers are now looking at credit scores and credit reports to determine whether or not to extend credit. So it really is impacting, because we're in the information age. So everybody knows everything about us. And so this really is impacting how, our ability to operate on a financial basis. So one of the things I find that are very interesting is, and it'll highlight this right here. Say you have two borrowers, they want to buy this truck, put no money down. One has mediocre credit and the other has excellent credit. And if you look at these numbers, and again, 11% for the mediocre credit. I have worked with clients who have had car loans in excess of 20% interest rates. And so, it's unbelievable. And look at this, the monthly payment's $140 a month. And when the truck's paid off, you're paying so much more in interest. It's so much more expensive to have mediocre or worse credit. Excellent credit, you just pay less in interest. And I want to kind of highlight the interest paid because you see the numbers big, but look at it in terms of percent. Someone with excellent credit pays 300% less in interest debt than someone with mediocre credit. And someone with bad credit will pay far more than that. So the cost of borrowing is 300% more. And that's a significant number. So a good question is, okay, so how are our credit scores determined? Because it's, it's kind of ambiguous. It's kind of like this secret formula. So here are how our credit scores are determined. It's a matter of new versus old credit, the credit mix, like secured credit, such as loans for cars and homes, versus unsecured credit, like credit cards. How long you've had history, payment history, are you paying on time, which is really the number one, advice I give. Make your payments on time. You don't have to pay it all off in total. If you can, that's great. But always make payments on time. That's the best way to help your credit and the best way to tank your credit. And then the last one is amounts owed. And then the last piece is where I want to spend some time on. It's utilization. So utilization is the amount of credit that's being used relative to the amount of credit that you have available. So I'm going to use an example. Let's say if somebody has 3 credit cards. One's an old one with no balance on it. They've had it forever, so it's got 0 balance, but a $5,000 credit limit. These other 2 also have $5,000 credit limit, but you have $2,500 on each card. So 3 cards, $5,000 of capacity in each one. So a total of $15,000 of credit capacity. The limits are $15,000 total. You're only using $2,500 and $2,500, so you're losing $5,000 of the $15,000 that's available. That utilization is 30%. What we're told is that if you get above 30% utilization, it will hurt your credit scores. And I've even heard that it's as low as 25%. So the idea is that you want to keep your balances as low as possible. The more the balances you have, the greater the negative impact on one's credit scores. One of the questions that I get frequently, and you too probably, Jay, is, I have an old credit card, haven't used it forever, should I cancel it? So in this case, the typical answer is no, don't cancel them, just don't use them. So your credit may go down a little bit and then it'll go back up. But in this case, it could be really damaging because all of a sudden you go from 3 credit cards and $15,000 of credit capacity down to $10,000 of credit capacity. But yet you still have these 2 cards that have $2,500 on them each. So you have $10,000 of credit capacity and $5,000 in which you're using the balances. All of a sudden your utilization goes from 30% to 50%. And that will greatly negatively impact one's credit scores. So the idea is, and I work with people, one segment I work with are people who are trying to rebuild their financial life. So sometimes they need to even get like secured credit cards. And what I tell them is once they get them, and usually like $300 to $500, is you want to try to, once you get a good credit history, is add and see if you can increase the credit capacity. So from $500 to $1,000. So you want to have that big gap between how much credit you're actually using and how much you can use. That will improve one's credit scores.
Even if those are at higher interest rates?
Yeah, the interest, that's a good question. In that case, the interest rates are not relevant. The interest rates become relevant if one is carrying a balance. And it is always my recommendation, if possible, to pay off credit cards in full every single month. It's one of the most expensive forms of debt that we have because interest rates on credit cards are, upwards of 20%. In fact, last year, the average interest rate on a credit card was 17%, which was the highest in 2 decades. So that's really, it's the first area one of the first areas to attack when wanting to improve one's credit and cash position.
So to kind of wrap that up a little bit, I agree with you. I think a lot of people think that whether they do certain different types of payoff strategies, be careful that even if you get something paid off, don't quickly shut it down until you truly think about what the ramifications of shutting that down will have, regardless of what the interest rates are. Because to, like you said, to become healthy financially, you need to control those costs. And if your credit, because you did a good job paying off a high interest, but then you accidentally shut it down, you actually might have hurt your chances of lowering your interest rates because you lowered your credit, because you've increased your debt to utilization ratios. And unless you look at that as a whole picture, you might be hurting one foot while you help the other, right?
Absolutely. I agree. I don't recommend in many, many cases that people cancel their credit cards unless it's, let's say, that they're always being charged a fee. That kind of can change the equation. But if there's no fees, there's no reason most of the time to cancel credit cards.
What about, in some of these nuances, it's hard to even tell because they're always changing the equation a little bit. What about department store cards? Because, my understanding is those are also looked poorly upon by credit reports. Are they?
I don't think so.
I leave the question at that.
Yeah, no, I don't think so. I don't think they're, if somebody has too much credit that they're using, that's the big red flag. At the same time, like mentioning the department stores, the private credit cards, those average interest rates are 27%. So if someone does get say a Target or a Macy's, you always want to pay that off in full. But having it is not a bad thing. And in fact, sometimes it's a good way for people to start their credit. In fact, honestly, that's how I started when I was a teenager. I got at the time it was Lazarus, now it's part of Macy's, but I actually got a credit card from a department store and started building my credit that way. And that's what we did with our kids as well. So it's a good starting point. So it's not really a negative. It's just, it becomes negative if you're using it to the max. The closer you get to the maximum limit, that's a negative. Okay. So in terms of credit scores, they range. They run from the 300s up to over 800. So this gives you and this is a recent chart to give you an idea of the credit scores. And there's 3 credit bureaus, and they run roughly the same. They're pretty similar. And it shows you the percent in the middle of the percent of people who have scores at this level. Anymore, it used to be where you could get a borrower for, say, home loan was around a 720. If you got over 700 or 720, you could get the best rate. There's been a bit of inflation in that regard. You need to get over 740 sometimes to get the very best rate. So this is it's important to guard your credit. And this gives you a very good idea of what happens if you become late. Look at the drop of one's credit scores if you miss a payment, or things get terrible, go to bankruptcy or foreclosure. So it is so critical to not max out cards and not be late. You don't have to pay it off in full, but at least make a payment if you have to, with a goal of eventually not having any credit card debt at all. There's a couple areas that they look at. They'll look at, in the credit bureaus, they get your name, social security number, some previous employment information, address, also public records. That is available on a credit report. And at the end, we'll talk about where to go get a credit report for free. But if there's public records of bankruptcies or liens or other negative things that are going through the court system, that will show up on a credit report, as well as all of the credit history. Student loans will show up on there, any other kinds, and it'll be on there for 7 years, unless there's a bankruptcy, which is 10 years. Question that I get is, it's important to be cautious about who pulls your credit. If you have your credit pulled too often, that can also be a negative. But let's say that you are going for a home and you need to shop for a mortgage. The credit bureaus can see, who's pulling your credit and what kind of organization. So it won't ding it too bad. And even if it is a temporary dip, it's only temporary. But you want to be kind of cautious and guard who's pulling your credit, because there's a lot of entities that will want to pull your credit at the drop of a hat. Now, areas that won't show up on a credit report is like your age, income, your employment status, the interest rates that you're paying on your current debts, if you're in credit counseling, but if you settle on credit. So there's certain things that won't show up on your credit report. And those are kind of things that are kept confidential. But there's quite a bit of information that's being shared. And again, all these entities are sharing information on all of us.
Right.
To get, I strongly recommend, by law, we are entitled to a free credit report once a year through 3 credit bureaus. And the 3 credit bureaus are Experian, Equifax, and TransUnion. So the place to go is the one at the top, annualcreditreport.com. We're entitled to a free credit report from each of those. What we don't get are scores, which I think is kind of snaky, but we don't get scores from that. However, what's important is to see the activity. It's also important to look for errors that are on your credit report. So one should pull a copy of the credit report at least once a year. If you are going to say, if you're planning on making a major purchase, like a car or a home, it would be advisable to pull all 3 credit bureaus so you can see, because they don't all report the same. They're virtually the same. But you'll find sometimes that something will show up on one credit bureau and won't show up on the others. And again, you want to look for errors because they do happen. Let's say it's your name's Bob Jones, and you get Bob Jones Jr. and Bob Jones III and Bob Jones Sr. You could be getting other people's credit information, which will definitely impact your credit for better or worse. So you want to guard it. And we recommend that you pull a credit report on yourself at least once a year. There's other ways of capturing credit information, credit scores. There's Credit Karma. Credit card companies now are offering credit scores. And it's important, I think, to understand that the scores that you get through, say, Credit Karma and some of these other organizations, it's a good ballpark, but it may not be quite accurate. Sometimes it could be a 20 or 30 point difference from when a creditor pulls your credit score versus what you get from Credit Karma. So just be aware of that there's going to be some fluctuation on that. But you want to take a look at that. And then, you want to, if you do have issues with your credit scores or what you see, if there's errors on the credit report, there's all kinds of remedies for correcting that, because there's laws out there that protect us, the Fair Credit Act and a couple other ones. The Fair Credit Reporting Act is one of them, that we can dispute online with the credit bureaus, and then they share this information. So this gives you a lot of information, hopefully, that is helpful in terms of pulling credit scores and questions that you might have. For me, it's all about, for me, financial literacy. It's about learning to read numbers just as one reads their words. And the more that we become financially literate, we're making better decisions. We have less strife, less stress, and really a more enjoyable life. So this is my mission. It's Jay's mission. So again, my goal is to make people financially healthy and others can make financially wealthy. So that's really what I have today, Jay. Any other questions that we want to kind of cover?
Well, and some discussion, I think it's very profound in the way that you mentioned it before, as far as you mentioned you help people become healthy financially, and we work with people to become wealthy. And it's interesting because both of those require good credit scores. Yeah. You cannot, well, you can. I mean, if you happen to earn enough income, you can overcome a lot of these, but most people, that's not the case. They have to work within the means they have. And I don't think enough emphasis, not maybe from the financial wellness community, but from individuals, not enough emphasis is put on fixing your credit as it is a budget. And I don't think a lot of people really understand how closely tied they are. To be off on your budget by a couple $100 per month could be a big deal, and your credit could be all of that, or could be part of that. Maybe not immediately, but within 6 months to a year, that could be the difference in cleaning up the credit, cleaning up your utilization, and doing some of those things. And then on the flip side, maybe you've got your budget under control, but now to become a better saver and to grow that savings habit into retirement savings or emergency funds or whatever it is, that credit allows you to refinance the house. It allows you to, your vehicle explanation there is great in the sense that, oh, the cost of the car is this. Well, it could have been this if you really focused on that credit side, which has a high impact on that budget, regardless of where you are in your life.
Oh yeah, absolutely. And I think what we both work on is mindfulness, being more mindful of one's money without obsessing on it.
Right.
But if like we said about the budgeting, when I coach people, my goal is to get them to budget regularly on a monthly basis for a little bit. But then after that idea is to know your numbers. It's kind of like just know them, know your numbers. And if you know your numbers, then you can operate and you don't have to obsess on it. If you feel, and then doing a budget after like 3 or 4 months of doing it monthly, I recommend maybe quarterly, or if there's a change, you got a raise, or maybe someone has a baby and there's some new expenses coming up, to look at the budget. But just being really on top of it, that's the key. And so many people are not. The one slide I had, a Gallup poll said 2/3 of people don't budget. And I think if people start budgeting more and became more mindful, they're making better decisions. They're getting better credit scores. When they go for debt, they're paying the best rate possible. And I've told people, the good thing about credit scores is that it's the great equalizer. If someone's making $35,000 a year and has an 800 score, and someone's making $350,000 a year with an 800 score, they can go in and get the exact same interest rate. Now, what they can buy is different, but they earned the exact same interest rate. So credit scores are a great equalizer. And being on top of that, you deserve the best rate. You can go and command that, and because you've earned it.
Yeah, and I think that one slide you showed, when you make a mistake, what I liked on that slide is, remember that the penalty for mistakes or late pays or whatever it is dramatically different for somebody at that 780 versus 680. And what that kind of tells you is you got to work to get a good score. You have to be focused. To sit there and make a small mistake when you have bad credit and you have a late payment, you're like, well, okay, what difference does it make? It hurt my score by 5 points. Well, it's because you've already been damaged on your score. If you really want to work hard, you have to be consistent about this. And the fact that, look at something as dramatic as the debt settlement, or where it's double the impact. Your score is only 100 higher, but the impact of the negative is double. So it just tells you, you got to work hard to stay on top of this mountain, right?
Yeah,
you got to work hard to get to it. But then when you get there, if you make the mistake, it is twice as damaging. So you got to wake up and be clear as to how hard you got to work to be the type of consumer that banks want to work with.
So I got a good story on that one. Years ago, I ran the sales department of a small mortgage company. I was doing mortgages too, and we focused on physicians. So I still remember this all these years ago. There was a doctor in Miami, Florida, making $500,000 a year, $500,000 a year, and he wanted to buy a condo. So I pulled his credit report, and his scores were terrible. He was consistently late on his cell phone bill, like a $50 bill. I said, why are you not paying your bill? And his ration, I still remember, it was, I can afford it. I just put it on my desk. I put it on, and I just forget about it, but I can afford to pay it. Well, then I said, you need to pay it, and I can't get you a loan because your scores are so bad because you're not paying your cell phone bill. So, attending to the details and guarding your credit reputation. I think that's so key. Again, your credit scores are our reputation to people who don't know us. And I am vigilant on guarding my reputation, both credit-wise as well as outside of credit-wise. And I think we need to be vigilant. And then, then you can earn the best rates and stay on top of it and then build a good financial life.
Well, this is a really important and as far as I'm concerned, an incredibly interesting area, because I don't think a lot of people put enough emphasis on this. And so hopefully through this dialogue, we'll continue to share the impact of a sound budget, sound credit management, and how important that is to a good foundation to a solid financial plan and being financially well. So thank you so much, Rick. Appreciate you joining us today. I think we'll be looking forward to all of our conversations with you on this budgeting concept, and looking forward to it. Anything you want to say to wrap this up? And I don't think we have any questions there, but anything you want to wrap up as we close out our discussion today?
Nope. I'm available for questions. Email me, call me, and whatever I can do to help. It's my passion and mission to help people become more solid on their finances.
Well, excellent. Well, thank you so much for everything. If anybody does have any questions or concerns, please feel free to reach out to Rick directly or let me know, and I'd be happy to help facilitate as best as possible regarding any questions or concerns you might have. So thank you so much for joining us today. And Rick, thank you for being here, and we'll be talking with you soon. Thank you.
It's a pleasure, Jay.
Take care.
And bye.